Hello and welcome. And with rising commodity costs, what's playing out is that the auto industry and in fact the auto component industry starts to face a little bit of headwind as a result. We're going to be speaking to GNA Axles today, a premier axle manufacturer based out of India, but has a large export exposure as well. And therefore, what does West Asia do in terms of the numbers going into FY27 plus with margins already hitting 16%? Is there scope for further expansion? Does top-line growth start to come through? What's playing out, and when should we expect growth to come through? So we'll try and get an understanding of all of this. 5 years, the stock has actually given zero returns, and I've taken August 2021 as the base actually, because we saw a sharp spike between March and August of 2021 on that stock price, but it's been zero since a while now, and it trades at a mid-teens PE. So valuations also not all that expensive, but has always traded typically in around this zone. In terms of con calls, it does not do any con calls. So this will be interesting in terms of a conversation. It gives us a perspective from the management itself as to what's playing out in the market for the company. Steel, of course, steel prices have been buoyant, and therefore earnings outlook on the back of that is what we'll get a perspective of. Do margins come off at least temporarily? Is the pass-through comfortable enough or not? We'll get a sense of that. And FY27, what does it hold in store in terms of a business outlook? Let me take a step back, try and give you a perspective about the company. It was incorporated in 1993. It operates in the auto component industry and has a market cap of around 1,700 crore. It's listed since 2016 on both exchanges. In terms of a product list, the first and the most important product that they manufacture is rear axle shafts. These are nothing but they basically transfer engine power to the wheels, and they allow for the wheels to turn. That's what an axle typically does. Spindle is nothing but a device around which a wheel kind of moves, and therefore you get a perspective as to what kind of products they manufacture. This broadly comprises around 90% of the top line for GNA Axles. They currently do only CV in a big fashion. The goal is to get into PV as well, to try and circumvent or try and stay away from that very cyclical CV cycle that the global CV industry sees. Third is drive shafts. They basically transmit torque between the drivetrain components within a vehicle, and then there is transmission shafts which carry rotational power within vehicle gear systems. Treat this typically as obviously two key components followed by certain other ancillaries as well that they manufacture. Vehicles that they are used in, first is on highway and then there's off highway. I'll talk about the on highway first. Trucks of all sizes, the smallest to even the 18-wheel trucks is what they furnish axles to. They also do it for buses, LCVs, pickup trucks and SUVs. The off highway is also very interesting in terms of the product suite that they try to cater to. Tractors, farm equipment is one, obviously construction equipment. Then there's mining and forestry as well, who they service in terms of their clients. Let's take a split of the product mix, and this is exactly what I was talking about. 90 to 95% of the products is rear axle and spindles. And then there are other shafts which contribute roughly 5% of the top line. This is FY25 numbers, mind you viewers. FY26, they don't put out a PPT, and therefore I don't have the data available, but once the annual report is out, we'll get that perspective as well. In terms of geography, 55% is export-facing, 45% is domestic-facing. Geography by continent, and let me try and bring that up again. This is approximate. Approximately 48% is Asia. North America is approximately 23%. South America is roughly 16%. Then there's Europe and Australia. That's broad brush, all of the continents that they service. In terms of countries, they've got United States, Mexico, Brazil, Japan, Europe, and many countries in Europe is who they service. You'll get a list of customers as well that they service. Dana, Merita, John Deere, some top customers, Kubota as well as part of the customer list. In terms of the business model, they manufacture in-house. They manufacture transmission components, drawings for global OEMs, integrated operations completely within their facility. They've got forging, heat treatment, machining and testing, which they do internally. And thereafter, they supply to commercial vehicles, tractors and passenger vehicle customers. PV is going to be that new segment which they are targeting, or which they've stated that they wish to target. I'm curious to know whether the tilt of CV versus PV changes in terms of the overall revenue mix, and if that changes, what does that do in terms of revenue predictability. Now, as we always do, let's try and understand the financials, and let's try and see as to what the financial numbers are indicating. You'll see largely flat on the top line. I've taken the 3-year CAGR, which is present above, but I've given you 5 years of revenue data, which is stacking up in front of you. Around 1,500 crore in terms of top line in the latest financial year, FY26, but a negative 2% CAGR on the top line over the last 3 years, which is FY23 to 26. That's how we've played the numbers today. In terms of EBITDA as well, there's been a 7% CAGR on EBITDA, so EBITDA has done fairly okay for itself. On the elevated base of FY23, it's done okay. What we've seen as a result of this play out in terms of the numbers is you've seen better margin come through as a result, and we look at that in the operational metrics. Net profit also has done okay. You've seen net profit go up from 89 crore in FY22 to 117 crore in FY26. So you've seen a decent inch up, but FY23 was that year where things really stood out. In terms of margins, you'll see that margins were at 14.5%, dipped to 13. Thereafter, we've seen a bit of a rebound towards 16.1% in FY26. That's where the current margin lies. In terms of the balance sheet now, because you've seen a decent margin uptick, likely from here margins going up will be difficult, and that's why we were cautious and we gave that a neutral rating in terms of margins. Balance sheet is around 1,000 crore book value, 1,700 crore in terms of market cap, so 1.7 times price to book is what this one trades at. You're looking at borrowing of around 184 crore, which is decent because you've got an EBITDA of around 230 odd crore, so you've got a decent coverage to EBITDA. Plus, it kind of takes care of interest costs and the like. You've also got a cash bank balance of around 40 crore is what they sit on. In terms of cash flow, well, this is where one of the likely problems stem from. You've got a stretched out cycle in terms of cash flow. What tends to happen is you have product that's sitting in India, thereafter gets exported, still sitting in your books, thereafter is received by the customer. You've still got a receivable sitting in your books, and therefore either inventory, either receivables, and both of those, the days is inching upwards as your customer exposure to exports goes up, and 55% of the top line is exports. And that's why you're seeing the kind of stretch cycle, at least in FY24 and FY25. Some bit of that unwound in FY26, which was a decent year. But that is basically what the concern is. The working capital days, the inventory days are a bit stretched. There is a meaningful attempt by the management to bring that down. But at the moment, we haven't seen results, at least in the current year, in a significant fashion. You've seen net cash flow, which matters far less than cash flow from operations. But you've seen that at negative 7 crore for this year. Let me talk about ROCEs. Now, this is where it starts to get interesting. So despite the kind of elevated working capital requirements, ROCEs, at least FY23, which was a solid year, came in at 21%. And thereafter as well, it's held up fairly well for itself at 15% odd. Question is, if working capital were to unwind, will ROCEs in fact get better? Well, we'll try and get a question to that. But at the moment, holding in at 15% and trading at sub 15 times price to earnings, it's not looking all that weak from an ROCE standpoint. And therefore, we've given that, keeping into context the valuation as well as the way in which the business is shaping up, we've given that a thumbs up. You've also got US tariffs, which is weighing down on the numbers. So that is the other thing that you want to keep in mind. In terms of shareholding now, that's the next metric. Promoters hold around 68% odd of the company. So no concerns at all there. FIs have a very wafer-thin holding. DIs have around 11% in terms of participation, and the balance 19% is held by the public. In terms of the interest, FY24 was where the number of shareholders went above 50,000 for the company. That has come down by 20%. So the interest seems to be diminishing, at least within the retail community, for the stock. And even the holding, public holding of retail investors has come down. So that's something you want to contextualize. In terms of risks, and this is something which is important to note, the top 10 customers account for roughly 80% of the top line of the company. Cyclicality and global CV, we spoke about that. Long receivable cycles, we spoke about that as well. US tariff impact, steel price volatility, we've spoken about all of this. But all of these are big risks for GNA Axles even going forward. In terms of valuations, your 1 year forward PE is approximately 13 times. Only one analyst covers it, and therefore we've not given you an analyst recommendation. But nonetheless, the 1 year forward PE gets priced in when that analyst is covering the stock. So 13 times is what this one trades at. The 2-year average is 10 to 17. The 5-year average is 10 to 24. Okay, so it trades at the lower end of the band over the last 5-year average, 5-year range. But the 5-year average is 14 times, and that's a very minor discount. And automotive axles, the peer, trades at around 16.5 times. So that's the other thing you want to keep in mind. Around 20% cheaper than its peer is what this one trades at. Now, let me go straight to management conversation. That kind of gives us a perspective as to how to look at this company and kind of set it up. But let me go across. We have Ranbir Singh joining us, who's the Managing Director and CEO at GNA Axles. Ranbir, great having you. Let me first start off by understanding from you how your assessment of FY26 has been, and the 16% margin you've clocked. Is there a risk to that in FY27, given all of the uncertainty that's playing out? West Asia, US tariffs, and steel prices, which are elevated. Give us a sense.
Harsh, good afternoon. Thank you very much for inviting me today.
So very good having you.
Regarding guidance earlier for FY26 was we were anticipating 15 to 20% top line drop, when the year started with a lot of tariffs and variables, and because tariffs were not settled down, sometimes announcements were for 50%, then 25%. So now the tariff is settled at 25%. And in the initial year, in the first 2 quarters, the dispatches and the sales to North America were very, very low, and our top line was totally affected. But from November or December onwards, dust was settled down, and our started supplies, as per the customer's fresh requirement, because inventories were at lowest level at that time in October, November. So then we have closed the top line with a loss of 4% against initial guidance of 15 to 17% drop in the top line. So there was a good recovery because of last 4 months. As so far as financial year 27 guidance, so now everything is leveled, and tariffs are settled. Customers have accepted the tariff levels, and we are back to business, and our order book is completely showing a very good requirement in Q1 and Q2, and every quarter to quarter we are growing by 8 to 10%. We are estimating Q1 also should be better by 10 to 12% as compared to last quarter. So this is the outlook for this year.
No, so Ranbir, point taken. So you've got probably a double-digit growth just about, which you will clock in Q1, Q2, but it's off a low base. Would you be worried therefore, and would therefore or are you being conservative? Are the chances of an outperformance very, very likely to that 8-10% kind of guidance you're giving?
No, I am talking about Q1 versus Q4 of last year. But if we compare year-on-year basis, this year our guidance is 16 to 18%. If all quarters will go with the same way, so total we will log over 20% growth.
Right, and what is the risk? Because there is still some amount of uncertainty from tariffs, and nearly a quarter of your sales come from the US. Is that still a very real risk?
Tariffs are already settled, and customers are, some customers we are paying the tariff and they are reimbursing us later, and it is billed to them.
Oh, okay. So you're able to pass through all of the tariffs to your customers?
Yes, exactly.
Okay, and have they been able to recover the tariffs that they've paid last year? Is that at all happening on ground?
Yes, they are able to recover,
Okay, okay, so that seems heartening. Okay, and in terms of, and that kind of creates more visibility in terms of growth for you, because your customers are now more confident of placing orders with you, and the fact that they will likely get reimbursement of tariff, even if there is a risk of future tariff as well?
There is no further risk for further enhancement in the tariff. It is already settled down with most of the countries. With India also, it is 25%. And some, our other competitors like other suppliers from South Korea and other areas, the tariff is there from everywhere. So there is no country left, uh, without tariff except Mexico and Canada.
Sure, sure. It's a totally new world, right, Ranbir? And that is evident from what you're suggesting as well. But give us a sense, what's playing out on the steel price cycle? Because that also impacts you. Of course, you can pass it through with a lag, is my understanding. Firstly, please confirm my understanding. Are you able to pass that through? Is it with a lag? So for a quarter, does your margin come off if steel prices rise?
Yes, like in India, the steel prices are rising from January onwards, and still our customers, the domestic customers, are settling down with the steel mills. So once it will be settled, and we will get from back date. So whatever extra we have paid to the steel, and similarly, there is a lot of impact on the value add also, like cutting tools, like energy cost, other things have gone up because of geopolitical reasons. So that is also under negotiation and which will be settled, we are hopeful, within this month.
And Ranbir, give us a sense of what the West Asia impact on your business is like currently.
This has affected the energy cost. Basically, furnace oil and LDO is used in the furnaces, so it is almost doubled. Commercial oils are doubled, and even the carbide is used for machining of the components. In all auto industry, all machining is done with the carbide tooling. Carbide is increased by 30 to 40%. Some type of tooling has gone up to 50% plus. So which is on the anvil and under negotiations with all customers, and which will be, they have given us confidence which will be settled from back date.
Okay. And therefore, what should the impact near term on your margins be like? What should it look like in terms of the impact?
We are hopeful it will be compensated and the margins should not affect.
So you should be able to hold on to the 16% margin. Is that what you're saying?
It is very early to say anything. On an average, historically, our margins are in the tune of 15 plus minus 1%. So because our product range is like that, where the steel consumption and tool consumption is very high, and we are able to sustain 15 or slightly over 15% margins. Only we have a hope to increase our top line, so where overall profit will grow.
Understood. So you should be able to hold 15%. Is that, Ranbir, is that something that you're comfortable with guiding?
That is what we are hopeful, as we are negotiating with our customers, and they agree to give us from 1st of March whatever extra cost steel, the forging industry has incurred, or auto parts industry, steel industry has incurred. So we are hopeful once it will be compensated and we will be able to maintain over 15% margins.
When do you get clarity that the assurance will actually translate to contractual payment which will come through? By what kind of timeline can we expect?
As per discussion, this will be compensated within this Q1.
Okay. If I were to just kind of switch focus, you've done CV in a big fashion always, and you've become a big player there. Talk to us about the PV side of things, because the aspiration for you is to get into PV as well. When do you get there in terms of timeline, and quantify the impact for us in terms of top line? You'll be at 1750 crore in terms of top line if you do 16 to 18% growth conservatively in the current financial year itself. How much of this is CV? How much of this is PV?
If we close 1750 crore this year, around 225 crore or 240 crore will be passenger cars, light vehicles.
Okay, so you're trying to say, Ranbir, that the CV growth is going to be very low to no growth, and it's actually going to be driven by PV. Just the fact that you're diversifying is what's driving your top line higher?
Yes, actually post-COVID we started investing in this area. Earlier we were only in the off-highway and commercial vehicle components, which are practically heavier component than SUVs and PAS cars, light vehicle uh, components. So then keep on investing in that area. But now it is giving us very good results, and company has earned a very good name in LV market, and we are negotiating globally for new businesses, and we are able to fetch a good chunk of business from North America, from South America, and Europe also.
Are these the same customers or are they different customers? Ranbir, give us a sense of that, because the
Most
PV
of-
market obviously typically will have a different cohort of customers, but give us a sense.
Suppose there are 6 new customers, so out of that, 4 are old customers in this product, and 4 to 5 new customers are there.
Okay, so there is also some customer diversification playing out. You've got maybe 80% of your top line coming from your top 10. Does that change significantly for you, or still some time away?
In next 4 to 5 years, as our plans are there, as we have a very strong board, get a lot of suggestions. The total picture will be different, and for last 10 years, we are trying to mitigate risks so that our top line should not erode. So, but now with the LV edition and new products and new customers, so so that this year we should maintain 20% growth, and later on year over 10% growth is being planned, and we are going to invest in that fashion so that top line should grow, and we should be able to de-risk the company.
Yeah, very heartening to hear. In terms of the growth pipeline itself, say you're doing 20% this year and thereafter 10%. Talk to us about where we are in terms of the CV cycle, so that we get a sense of whether there is any upside potential to that growth guidance which you've given.
In CV, still there is a potential to grow by another 20 to 25%. And the 2 main products are there in CV. Those are hollow spindles and axle shafts. In both, we are debottlenecking and adding the customers.
And what does the debottlenecking do to your margins? Say steady state currently you're at 16. If you just debottleneck, what happens to your margins? Where do they go?
Margins will be same. That will help us to add the capacity to serve more business and new customers. That is the whole game plan.
Okay, so how much? Okay, so currently what's your capacity utilization, and how much would the debottlenecking add in terms of potential top line for you?
Actually, we have 2 areas in manufacturing. One is forging and heat treatment. Then product goes to machine shop and finishing, and for final dispatch. We are able to enhance our forging capacity in last 3-4 years, because with the top line negative growth or with the flat growth, but we have not stopped the investments in the forging, because forging is a long lead time cycle investment. So we are sitting on 30% additional capacity in the forging and heat treatment. So debottlenecking is done in the machining, when we get the new contracts and new orders. So that in the shortest possible time, it is being done.
Got it. Okay, yeah, I get your perspective. Give us a sense, the other problem or the other headwind you've faced, we won't call it a problem, is the fact that your working capital days have gone up, and they continue to inch upwards. Of course, they've come off slightly in FY26. But give us a sense as to what's playing out over there. Is there a conscious effort to reduce working capital requirements? If so, what's the kind of timeline we're looking at? Is there an unwind expected?
Whenever we get a new contract, we have to feed the material 8 to 10 months ago, and before they start pulling the material. So it goes to the warehouse for the new part numbers and new customers. So once it reaches to a certain level, only then they start using the material, and after consumption, they pay after 63 days. So which is a pretty long cycle.
And therefore, is there scope for improvement there at all, or is this how the business model will work?
Harsh, we should not say there is no scope of improvement in any working. Scope of improvement is always there.
No, but realistically, sir, what are the targets like? Give us that sense. Of
We
course,
are
there's scope
working.
for improvement.
Our
What are the
logistic
targets?
people and our marketing, they are working on this, and definitely some improvement will be there.
How much? Sir, 10%? Is that something that we can expect in terms of working capital days improvement?
I can't say immediately. I have to go through
Okay,
the
sir.
numbers.
I
Exact
tried.
numbers.
I tried. Okay. What's the outlook with regard to increasing capacity? Give us that sense. And how much are you going to be investing? You're going to do roughly 200 to 250 crore of free cash flow coming straight to you post taxes likely. In the current year, FY27, you've done maybe 170, 180 crore if my math serves me right and memory serves me right. What do you do with the money?
Last year, we have done around 140 crore investment. Out of that, over 40 crore was in the solar investment, solar generation, and we are going to start one solar park with the 13, 14 megawatt DC generation, over 10 megawatt AC pure power generation to offset our ESG norms requirement, and which will be started in next 2 to 3 months time. That investment was also a major investment over and above our manufacturing capacities. So we are for last 3 years we are investing over 80 to 90 crore in the capacity and debottlenecking, and which will continue this year also.
Okay. Mr. Singh, therefore, do ROCs remain steady, 15% plus? Is that something which is an internal target?
Yes, it can improve also a little bit. Year on year, our target is to improve ROC also.
Okay. How much?
Maybe 1% or whatever it is, but target is there to improve.
Sure. Okay. Thank you so much, Ranbir, for coming in and speaking with us. You've been very candid in this conversation. And viewers, that's all the time we have on this edition of All About Your Company. Thanks so much for tuning in. More action on the other side. You want to stay here on ET Now.